Welcome to the Deep Dive, where we crack open the most complex financial calls so you don't have to. Today, we are deep diving into the third quarter 2025 earnings call for Ford Motor Company. And talk about a paradox. This call was a textbook example. Ford delivered a knockout Q3 earnings beat, yet immediately followed that up by reducing its full-year guidance. Logically, the stock should have suffered. Right. Wrong. The market reacted overwhelmingly positive. The stock surged 3% after hours, and by the end of the next trading session, it was up over 12%. That's a massive rejection of the near-term bad news.
It is truly fascinating. I mean, watching investors just dismiss immediate headwinds for a 12% jump like that. Our mission today is to unpack the core financials and figure out precisely why the market looked past that Q4 supply shock, that big red warning light, and instead fixated entirely on the underlying operational strength and the specific, powerful 2026 recovery narrative that management laid out. We're going to show you the hidden tailwinds that really sparked this rally.
All right, let's get straight to the immediate results that kind of set the stage for this drama. Ford truly delivered a strong beat in Q3. Adjusted earnings per share came in at 45 cents. That blew past the street consensus, which was sitting down around, $35.36?
Yeah, easily beat it. And that wasn't just noise. It was driven by record revenue. Ford posted $50.5 billion in global revenue. That's a huge number, topping consensus by several $billion and marking 9% year-over-year growth. And for the technically minded, GAAP EPS was 0.61 cents, a strong surge compared to the $2.22 from the previous year. So strong performance there. Now here is the pivot point that created all the market tension. Despite all that fantastic Q3 execution, management was forced to cut the full year 2025 adjusted EBIT outlook. They brought it down to a range of $6.0 billion to $6.5 billion. That's down from their previous higher range of $6.5 billion to $7.5 billion.
The entire reason for that cut boils down to one singular, massive supply chain shock: the fire at the Noveliss aluminum plant.
Exactly. But what stood out immediately was management's tone. They signaled, extreme confidence. They noted that their Q3 operational execution was so strong that had the Noveliss disruption not occurred, they would have actually raised guidance, raised it to the high end of the old range, which would have put them well over $8.0 billion.
Right, $8 billion. That sounds a bit like management bravado, trying to shift the focus.
Yeah.
Was there any pushback on that hypothetical figure during the call?
There was some skepticism, sure, but the facts underpinning the core business performance, the pricing, the mix, the cost execution, were undeniably strong. The message was clear. This cut isn't an execution failure, it's a factory fire. The core business, they argued, is firing on all cylinders.
Okay, so let's talk about the specific injury the Noveliss fire inflicted, because understanding this is really key to understanding the Q4 expectation. That September fire at the Oswego aluminum plant will result in a punishing $1.5 billion to $2.0 billion adjusted EBIT headwind, and almost entirely concentrated in the fourth quarter, right?
That's right, all hitting Q4. And the reason it's so painful, that Noveliss facility provides the lightweight, high-strength aluminum necessary for the F-Series body and bed. When that aluminum supply just vanishes, F-Series output crumbles. They anticipate losing between 90,000 and 100,000 F-Series units by year-end because of this.
Wow, so this is a huge, expensive pothole, definitely, but not really a structural crack in the demand for trucks. Is that the idea?
Precisely, and that's what seemed to impress investors. Management immediately framed it as a timing problem that they can solve. They outlined a recovery strategy designed to mitigate at least $1 billion of that hit in 2026, effectively making up for a big chunk of those lost sales.
So what are the concrete actionable steps? How are they going to chase down those lost units next year?
They are aggressively ramping capacity. They're talking about adding up to 1,000 new jobs, utilizing a third shift at the Dearborn truck plant, and boosting line speed at Kentucky Truck. These physical actions are budgeted to recover roughly 50,000 of the lost F-Series units throughout 2026. So they're committing serious capital and manpower to claw back every dollar they can.
And crucially, management noted that they ended Q3 with a surprisingly strong F-Series stock, an 88-day supply. That's actually above the segment average, isn't it?
It is, and that existing inventory provides a buffer. It's expected to insulate Q4 retail sales from the near-term production impacts. So while Q4 wholesale shipments take a big hit, the retail channel should remain relatively stable. It ensures the problem is confined mostly to wholesale and, working capital timing, not lost customers.
But if Q4 is going to be dominated by this massive temporary supply crunch, where's the underlying proof of strength that the market cheered? That brings us to the true profit engines, Ford Pro and Ford Blue. Let's start with the commercial side, Ford Pro.
Ford Pro is, well, it's the golden child right now. It delivered a spectacular $2.0 billion EBIT with a robust double-digit margin on $17.4 billion in revenue. Just fantastic results. This segment's entire strategy is built for durability, moving far beyond merely selling a transit van.
Yeah, and the software numbers seem to back up that durability thesis. Paid software subscriptions grew 8% year over year, hitting 818,000 subscribers. That recurring revenue stream is a huge long-term data point.
It really demonstrates strategic diversification. They are now deeply entrenched across channels from large corporations to small to medium businesses, which actually offset some softness they saw in government fleet sales this quarter. But what's structurally important is the physical service layer they are building out. I mean, they added 1,700 new service bays and 500 new mobile service vans over the past year alone. That physical infrastructure creates stickiness and much higher service parts capture rates. It's a smart play.
Okay, moving to Ford Blue, the traditional internal combustion engine, or ICE core. That posted $1.5 billion EBIT. You pointed out earlier that revenue growth actually exceeded the rate of wholesale unit growth. What does that signal about their strategy there?
It signals pure pricing discipline and excellent product mix. They are absolutely prioritizing margin over volume. Products like the all-new Expedition are hot, gaining 3 points of segment share, with 75% of those buyers opting for high-end trims like the Tremor package, just printing money on those. They are maximizing profitability in the segments they already dominate, specifically the hybrid truck market, where they hold about 70% share. They own that space. And let's not ignore the cost curve, which, let's be honest, has been a pain point for Ford in the past. Management detailed real progress in industrial operations. Warranty costs were down $450 million year over year in Q3 alone. That's significant. And this is directly tied to radically improved launch quality. They now have 6 new nameplates recognized as best-in-class in independent J.D. Power data. That's proof. They remain committed to delivering a net $1 billion cost improvement for the full year 2025, excluding any tariff impacts.
Now we have to address the evolution of the EV landscape. Model E. This remains the challenge, doesn't it? Year to date, Model E posted a massive $3.6 billion loss, with roughly $3 billion of that coming from first-generation products like the Mach-E and Lightning. Ouch.
Yeah. That loss really validates the major capital expenditure course correction we saw them announce earlier this year. It makes sense now. The strategy is now clearly about pacing EV commitments, which means stepping back from aggressive spending in some areas and focusing capital on the profitable truck, SUV, and hybrid segments where demand is actually strongest today.
But they aren't abandoning the future completely. They are focused on the universal EV platform, the UEV.
That's their long game. This UEV platform is designed specifically for the affordable commuter market. They're targeting a starting price around $30,000. It's a clean sheet design, 95% of the sourcing is already complete, and they're on track for a 2027 launch. Major equipment installation is beginning in Louisville later this year, so it shows disciplined investment where they see mass market margin potential down the road.
Okay, let's talk about the major financial game changers that the market is celebrating. These regulatory tailwinds that unlock mix optimization, starting with tariffs. What happened there?
This is a huge, quantifiable win for them. Policy developments effectively reduced the net tariff headwind for full year 2025 from an expected $2 billion down to just $1 billion. This means management expects a massive $1 billion positive retroactive benefit to be recorded in Q4. That dramatically offsets the operational costs they incurred earlier in the year from tariffs. And the forecast for 2026 is a similar net impact of about $1 billion, so a big relief.
Wow, $1 billion is not small change. And then there's emissions compliance, which feels like maybe the biggest hidden tailwind of all for 2026. Explain that for the non-auto experts listening.
Oh, it's a potential game changer. So historically, auto companies that sell massive, powerful vehicles, think F-150 Raptor or Super Duty, often exceed environmental limits set by regulators. To balance this out and meet regulatory requirements, they typically have to purchase compliance credits. Essentially, regulatory get-out-of-jail-free cards from competitors who sell lots of small, efficient cars or EVs. Management had anticipated purchase obligations of about $2.5 billion just for these credits to comply with the prior standards. That's a huge cost. But anticipated relief from tailpipe emissions rules could entirely eliminate those compliance headwinds in 2026. This allows management to basically be uncuffed. They can maximize the sale of their highest margin, most profitable vehicles like the Tremor, the Raptor, those extended range hybrids without worrying about billions in regulatory penalties or buying expensive credits. The combined effect of the tariff reduction and this potential compliance relief is just enormous for their bottom line.
Okay, let's pull this all together.
Yeah, if we synthesize this, the reason the stock rallied 12% becomes crystal clear, doesn't it? The market is aggressively factoring in the setup for 2026. The core business is strong. The company has concrete $1 billion plus cost improvements coming. Plus, they have an immediate $1 billion plus benefit from the tariff relief, plus the potential elimination of that $2.5 billion regulatory compliance headwind. Suddenly, the Noveliss fire looks merely like a temporary expensive accounting challenge that actually masks a lot of underlying strength and future tailwinds.
And the durability of the balance sheet supports this confidence, too. Ford posted $4.3 billion in adjusted free cash flow just in Q3. That's strong. They have an immense cash buffer with $33 billion in cash and $54 billion in total liquidity. Even their lending arm, Ford Credit, remains solid. Origination FICO scores are exceeding 750, meaning they are originating high-quality, reliable loans, not chasing risky borrowers. So you have to ask yourself, given the focus on operational efficiency and managing these complex supply and regulatory risks, are investors right to reward this highly disciplined pivot back toward maximizing profitable ICE and hybrids while slowing the Gen 1 EV ramp? That's really the core thesis you must develop now if you're looking at Ford. All right, it's time for our non-financial advice segment where we take the core thesis of the call and translate it into a specific, perhaps outrageous but plausible trade idea. What have you got?
Okay, my pitch is aggressive, definitely not advice, but here it is. Establish a long position in Ford F, funded by shorting the pure play EV capacity play. Think companies primarily valued on future EV volume potential alone.
Okay, walk us through the mechanics and the conviction behind that trade. Why long Ford, short EV pure plays?
The street, I think, is currently over-indexing the noise that Q4 Noveliss hit and severely underestimating the quantifiable magnitude of the 2026 recovery. We are talking about potentially $1 billion in Noveliss capacity makeup, plus a minimum of $1 billion in structural cost savings, plus the elimination of that multi-billion-dollar emissions compliance headwind. That's a massive potential lift to earnings power. When you combine those factors, the potential setup for the 2026 EBIT guidance looks conservative right now, frankly. Management is also showing sustained pricing discipline. They expect inventory to lean down further into 2026 to about 520,000 gross stock units, which helps sustain pricing power in the most profitable truck and SUV segments. So the combination of strong cash flow, a disciplined capital strategy, $9 billion capex target seems reasonable, and these huge regulatory tailwinds offers a significant multi-billion-dollar margin buffer that is simply not fully priced into the shares today, in my view. This is essentially a bet on regulatory foresight and industrial execution delivering operational excess cash, funded by betting against companies still burning cash to build EV capacity without clear profitability paths.
Okay, so to recap this deep dive, Ford delivered record revenue in a massive Q3 beat, but the narrative really hinges on their disciplined response to the Noveliss fire and that concrete 2026 recovery plan.
Exactly. The strategic shift is now fully baked in, prioritizing the durable profitability of Ford Pro, maximizing the mix of high-margin ICE and hybrid trucks, all while benefiting from massive, immediate regulatory tailwinds in both tariffs and emissions compliance. It's a potent mix. So, our final provocative thought for you is this. Management is aggressively leveraging both industrial execution and regulatory changes to maximize margins from their profitable core. If they successfully execute this, let's call it $3 billion plus regulatory and operational setup for 2026, how much higher can their profitability actually get if the EV market stabilizes even slightly and they continue to just dominate the commercial and profitable truck segments?
That is the multi-billion-dollar question you must keep top of mind as you evaluate the road ahead for Ford. Thank you for joining the deep dive.